A good portfolio is one that achieves your financial goals, but it's easy to lose sight of what you're doing and end up with something that's not fit for purpose. In this video, I'll show you what I consider when looking at a portfolio, so you too can go through this process and review whether you're still on track. Before you think about a portfolio, I think it's critical to remember why you're investing in the first place. And that's because we have various goals throughout life. For example, when you're young, you probably want to save up to buy a house. Maybe you have to pay for your children's education. Maybe you have to manage your family's wealth throughout your entire life. Or perhaps you're just saving for a pension and have to build up a pot that's large enough to last you your lifetime. But what's critical is that you're aware of those goals, and then you can start to build a portfolio to achieve those goals. But the most important things are, when will you need the money and how much will you need? That's how you turn your goals into numbers, and that's how you can work back to a portfolio. In coaching sessions, I'm often asked to give feedback on people's portfolios, and I've done this for thousands of hours now, and I've noticed certain consistent patterns about where people go wrong. But I'll also share general principles I've learnt about how to stay on course. And one pattern that I often see is clutter in a portfolio. What do I mean by clutter? Well, if you see a portfolio with hundreds of items in it, or often dozens of items, then usually it's a sign that someone's built up that portfolio over time in a kind of willy-nilly fashion. And almost always it's because they've read share magazines. So for example, there's a magazine in the UK called, unsurprisingly, Shares, and if we look at a selection of the covers, you can see what they do. They build a narrative around certain stocks and why they think these stocks are good investments. So it's just human nature that if we read these magazines, eventually we'll come across an article that chimes with us and we'll think, yeah, that sounds reasonable. And then we'll go off and we'll buy that share or that fund. The problem with that is that over time what will happen is that you'll just build up lots of different stocks and you may not have enough time to manage the portfolio and then sell the individual stocks or funds. So what you end up with is this really cluttered structure where things have built up over time and never been cleaned out. So for example, I see portfolios like this one. It contains dozens of different investments. Some of them are funds, some of them are single stocks, and it's difficult to make sense of it. So one of the things I do for people is if they give me the list of funds, I'll work out this thing which is called a cladogram. That's a fancy name for something which sometimes I call a Scooby-Doo tree. But the idea is that things which are close together on the leaves of this tree have a high correlation. In other words, their price tends to move up and down together. How does that help, you might be thinking? Well, immediately you can see this structure of this portfolio because things which are similar cluster together. So for example, if we slide a ruler across this page and we slice the tree into two branches, notice how the top branches are all bond funds and the bottom branches are all stock funds. And that's because bond funds and stock funds tend to move up and down in sync with each other, whereas stock funds and bond funds move in opposite directions. They have a low correlation. Now the alternative is to look at something called a correlation matrix, which is just a big table of numbers, and it's often difficult to make sense of that. Whereas this thing is very compelling, it's very simple, and you can see the structure quite easily. Furthermore, if you wanted to simplify this portfolio, what you can do is slide that ruler across to the number of branches you want and simply choose your favorite fund from each of those branches. And then the ones which you don't choose, you simply sell. Now, if you sliced it into two branches, you'll just end up with two funds. You wouldn't replace all of the stocks with a single stock. Of course, you choose a fund which captures their overall structure. For example, a global equity fund. For example, for the stock branch, you could use the Fidelity Index World Fund. Now that won't give you exactly the same returns, of course, but it'll give you similar returns to what you would have received if you'd have just kept the whole portfolio. And at the same time, it's going to maintain the diversification because you'd have chosen a bond fund and a stock fund. If you want to make it more nuanced, then just include more branches. But this is a really nice way to declutter your portfolio. Now for our PensionCraft premium website members, I've started doing something called portfolio critiques. The idea is that they submit their portfolios, but also their investment goals, their age, when they plan to retire, for example, and I give feedback on the portfolio, anonymously of course. And what I try to do is to share the strengths and the weaknesses I see in the portfolio, but I also try to illustrate general principles about building a portfolio as we go along through their critique. So if you do want to learn more about the benefits of joining our community, we have lots of members-only videos. We also have a chat application so you can ask questions whenever you want. Then just go to our website, pensioncraft.com/membership. You'll also find that link in the description below. Another problem I often see is to do with the amount of risk in a portfolio, and that's essentially about how much is invested in risky assets. Now, when I talk about risky assets, primarily what I'm talking about are equity funds. Why are they risky? Well, they're crashy by nature. Long term, they drift upwards, but they do have these setbacks and the prices fluctuate a lot. Whereas if I invest in safe assets, there'll be less fluctuations, there'll be less volatility, and there'll be less crashes, but usually also there'll be less return. So the primary thing you're doing when you build a portfolio is balancing these two things, risk and return, by balancing the amounts of these risky and low risk investments. Now you may find this surprising, but what I often see is that some people don't have enough risk in their portfolio. Perhaps the best way to understand this is as a diagram where we've got the volatility or the crashiness of the portfolio on the x-axis, ranging from very safe money market funds and cash on the far left, all the way up to incredibly risky investments, leveraged investments, call options on Tesla, cryptocurrency on the far right. And what you can see is if we think about the likelihood of success, which is defined as meeting your financial goals, that has a kind of sweet spot. You don't want to have too much risk because then your portfolio could crash and you could fail to meet your goal. And you don't want to have too little risk because if that's the case, then the return you receive will simply be insufficient to get to where you need to be. Now, there are two factors about you which determine what's best in terms of the risk you take. The first factor is risk capacity. That's your capacity to make a loss without it affecting your quality of life. So, for example, imagine that you have a vast excess of savings and you don't have to generate much return at all in order to meet your financial goals. Well, in that case, your risk capacity is very large. Because even if you do suffer a setback, if markets fall, then you'll still be able to live the life you need to live. Whereas if you're living hand to mouth and you have insufficient savings, then it's much closer to the wire and you have much less risk capacity. So there you'd be much more careful, much more cautious with the risk you take in your portfolio. The second factor is to do with your risk appetite. This is your emotional capacity to take a loss. It may be that you have a huge risk capacity, you can weather a financial loss, but if it's going to really upset you, then you don't have the emotional capacity to deal with that loss. So really finding the level of risk which is appropriate for you depends on your financial goals, but also on factors to do with you, your risk capacity and your risk appetite. And in the case you can see here, the risk appetite is well below the risk capacity. This is someone who's very cautious and who, for example, doesn't want to buy stocks because they're scared they'll crash. So, for example, someone might have a lot of money tied up in a money market fund after selling a business and they're scared to allocate it. So as you can see in this case, the dashed yellow line is the portfolio that this person's bought, which is the highest risk one that they can stomach based on their risk appetite, but the probability of meeting their financial goals is still quite low. So if that's the case, if you're finding that you're too cautious, then I think it's worthwhile thinking about long-term returns and the probability of not meeting your goals. And historical data is a good way to calibrate your expectations. Here, for example, you can see the 5 Vanguard life strategy funds in the UK. They were created in 2011, and I've plotted their returns from 2011 up to 2024. Notice that the one which has performed best is Life Strategy 100, the one which is 100% stocks. Life Strategy 20, which is only 20% stocks, 80% bonds, has hugely underperformed that fund. If we look at the annual returns, you can see that Life Strategy 20 generated less than 4% per year on average, whereas Life Strategy 100 generated about 10% per year over that period. Now, it wasn't an easy ride, it was very volatile, it was quite crashy, but Life Strategy 100 paid you back for taking the additional risk and weathering those storms. The contrast between those funds is even more stark if I inflation adjust the returns using UK CPI inflation. Now you can see that Life Strategy 20 has actually not beaten inflation over its entire lifetime. So that's a period of 13 years. Whereas Life Strategy 100 has almost generated 6% returns above inflation over that same period. So really that's what it's about. How much can you beat inflation over the long term? And usually equity, stock markets are the way to do that inflation busting. So if I do meet someone who's 30 years old and they've got very little invested in the stock market, or they've got a big bond allocation, then you have to kind of explain that that's unlikely to generate much return long term. And they'd probably be better off with equity, assuming, of course, that they're willing to take that risk, if their risk appetite is sufficient to have a higher equity portfolio. Another problem is people who have too much risk in their portfolio. So here you can see the risk capacity is the same, but the risk appetite is much higher than their risk capacity. So for whatever reason, they're quite willing to take very, very high risks with very risky investments, despite the fact that a loss would adversely affect them. So here again, you can see that the likelihood of success, the chance of meeting their financial goals, is very low. And the kind of risks which I see in these cases are concentration risks. This is when you've got too much invested in a certain thing. For example, they could have too much invested in a small group of stocks. Maybe they've just got 3 or 4 stocks in their portfolio and they've got huge conviction that these stocks will do well. Often they're tech stocks, and it may well be the case that the tech stock sector undergoes a little bit of a setback or a big setback, in which case these people will be wiped out. Another kind of problem which I've seen in the past is that people have too much in a given style of investing. For example, many people in the UK bought Baillie Gifford funds. It's a well-respected fund manager and it achieved incredible returns for many of its funds over this period from 2004 to 2021. Here I've shown the annualized return for just 5 of their funds, and they're very respectable indeed. For the lowest return, that's Edinburgh Worldwide Investment Trust, you can see that on average it returned 15% per year over this period. And the best performing fund in the group, which is Scottish Mortgage Investment Trust, almost generated 20% per year over these 17 years. So it was quite reasonable to expect that these returns would continue in future, unless you have some kind of concentration risk. And in this case, it was a concentration in a given style. This is the growth style of investing. Now, it's not immediately obvious if you look at the titles of the funds that they are growth funds. But then inevitably, this style of investing came a cropper in 2022 in the tech wreck. And many of these funds have suffered a severe setback from which they haven't recovered. Edinburgh Worldwide Investment Trust, for example, is still down by over 27%. So I have spoken to people who bought many of these funds from Baillie Gifford and ended up buying the same risk. And that way they weren't diversifying their portfolio, they bought more of the same risk, and then when that style of investment fell, they suffered very severe losses. So just make sure that you understand what the style tilt of your portfolio is, and that you are fairly diversified across different styles. Another concentration I often see is in the tech sector. That's because it's done very well, particularly in the US, and that means that people think it'll continue to do well in the future. And yet what this concentration risk often means is that there'll be a setback at some point in the future and their portfolio will lack diversification. And kind of related to that is the US as a whole. And this is a market which people are simply piling into at the moment because it's performed very well for a very long period of time. But has that always been the case? If we plot the value of 2 indices, that's MSCI USA divided by MSCI Developed ex-USA, that's what you can see on this graph. Notice that you can split time into neat little periods. Certainly has been the case since 2008 that the US has massively outperformed. That's why this line is going up. MSCI USA massively outperformed MSCI World ex-USA. But this is a recency bias. And if you look at the time periods before 2008, for example, the 6-year period from 2002 to 2008, the US underperformed very significantly. And another much longer period of US underperformance was between 1969 and 1988. So this is something which I always point out if I see too much US allocation in a portfolio. The thing is, if you buy a global index, you'll have 55 to 60% US exposure anyway. So if I do see someone who's only bought the S&P 500 as the stock representation in their portfolio, I point out this concentration risk. And also the longer term history of the US versus the rest of the world. And then the final type of concentration is in asset type. So if you just invest in stocks, they are crashy. And when stocks fall, they tend to fall together. If you do want to diversify, you'd probably choose another asset type. Some of those safe investments like money market funds, bond funds, or even commodities like gold, for example. Those on average may reduce your overall return, but they also reduce the risk in your portfolio and the crashiness of your portfolio. And if you're in a relationship, it's not just your risk appetite which matters, it's also that of your partner. And what I often see is a big difference in risk appetite in a relationship. What usually ends up happening is that the person who's more risk averse wins the argument, and they end up with a portfolio which may not have enough risk in it. So how could we bring the risk appetite between two partners closer into sync with one another? I think education might be the way to do that. As you learn more about investing, your attitude to risk changes as well. I think people become more willing to take the ups and downs of the equity market once they realize how good those long-term returns are and the fact that they usually beat inflation. But what you should never do is build a portfolio that your partner will not be happy with. A relationship is very much to do about money, and this is often the source of friction in a relationship. And finally, another problem I often see is that a portfolio is too complicated. Now, sometimes this is because an advisor or a wealth manager has constructed a portfolio for you, and it's got lots of moving parts and you don't really understand what's going on. I'm often asked to explain how a portfolio has been constructed and what it means. And in particular for high net worth clients, there's a type of product called a structured product, which embeds derivatives with index products, sometimes with currency products, to create something which in theory is crafted to that client's needs, but in practice needs a PhD in physics or mathematics to understand it. And I'd argue that that's a mistake. Even if you trust the advisor that what they've created is suitable, you may not be comfortable with the product. And if something goes wrong, you'll feel awful about it because you'll have ended up buying something which you didn't understand in the first place. It's usually much better to understand how what you've bought actually works. And if your advisor has created something too complex, will push back, say, I don't understand this, and it's their job to explain it to you. And if you're still not happy, perhaps you can convince them to simplify the portfolio. In conclusion then, I think one of the most important principles here is simplicity. Have a portfolio which is just complex enough to achieve your goals without being too complex to manage or understand. And usually that means very few moving parts, not many investments at all. I've just got one fund in my core portfolio, for example. Secondly, be aware of what your goals are and whether you're on target to achieve that goal. Look at long-term returns and see what the likelihood of achieving those goals is. But also you have to find a portfolio that matches your risk capacity, that's your financial ability to weather setbacks, and your emotional capacity to weather those setbacks, that's your risk appetite, but also that of your partner. There's no point in buying a portfolio which is just suitable for you. And I think if you do those things, you're much more likely to end up with a portfolio that you can stick with long term, and you'll be more likely to achieve your financial goals. If you do have something complex, it'll take lots of time to maintain the portfolio, and I think you're much less likely to stick with it and achieve a good outcome. So remember, if you do want to join our membership and you want to have a go at this portfolio critique, then you can easily do that. Just go to our website, pensioncraft.com/membership. There'll also be a link to that in the description below. And as always, thank you for listening.